Welcome to our Sunday evening live Q&A, and today we've got an hour together, and it's the usual procedure. So if you are one of our supporters on YouTube, we'll see the little crown next to your name and we'll answer your question first. And if you have super chatted us, also we'll push your question right to the front of the queue. So remember, that obviously helps us if you do that. And as usual, if you like this, if you give it a thumbs up, it also helps us thanks to the algorithm. And of course, if you haven't subscribed, then do, because then you won't miss the stuff that we produce. So let me just kind of recap what's been going on in markets recently. There's an interesting kind of summary story over on Bloomberg. So if I just share my screen, you'll be able to see this. So this is the story on Bloomy. And it's basically talking about risk appetite waning. Now, you won't see this as a fall in the equity indices. So the S&P 500 hasn't fallen really at all. But if you look at things like the VIX index, which is the fear index, but that's based on option volatility for out-of-the-money options on stocks in the S&P 500. And so that's based on how much people are willing to pay for in terms of premium for out-of-the-money puts and out-of-the-money calls. And if you compare that with realized volatility, which is how much the actual index has moved, then you can see that that's at the highest premium that it's been at in years. So here the black line is VIX and the red line is the 20-day realized volatility. And you can see the black line's far above realized volatility. So that suggests that people are willing to pay more than usual for out of the money options. It could be on the upside or the downside, but this tells us that people are willing to pay for these out of the money puts and calls. And then if you look at things like the IPO index, for example, and Goldman has an index which tracks expensive US tech stocks, and that's fallen quite sharply over the last week or so. And so has the IPO index, which tracks newly issued stocks which have just been through the IPO process, and it tracks those for a period of 2 years. Both of them suggest that the kind of frothiness in the market has certainly seen a pullback over the last week or so. And then if we look at things like put to call ratios on the SIBO exchange, again, you're seeing more puts relative to calls, which suggests that people are betting on more downside. So that's at a 1 month high as well. So crypto obviously also an asset class which is a risky asset. The risk appetite there has also fallen. So I think it's fair to say that risk appetite isn't as high as it was even just a week ago. So let me switch back to the questions and we'll start to answer some of your questions now. So back to me. And oh, it's not Sunday, Laura tells me. So she's absolutely right. It's Thursday. Okay. The reason why I thought it was Sunday was because we have a members only Q&A on a Sunday evening, every other Sunday. So that's why I got the two confused. Right. So first question is from Andreas, who says, are bond yields, e.g. the 10-year treasury, positively correlated with small cap prices, like the Russell 2000 index? So when they go up, the Russell 2000 goes up too. Normally, I'd expect it to be the other way around, Andreas, because usually the kind of small caps will be the growth stocks. Growth is negatively correlated with yield because generally growth stocks will have a longer duration. At least that's the kind of way most people understand it. Or if you look at a discounted cash flow model, for a growth stock, more of the cash flows happen in the future because it's going to grow its cash flows in future, so that when the interest rate increases, those big future cash flows get discounted more heavily. So those growth stocks will have more sensitivity to interest rates. That's the logic. Or you could say they may depend more on funding for growth. And if funding becomes more expensive because interest rates are higher, then it'll kind of suppress their growth and reduce their value today. So there are various ways to look at that, intuitive ways. But my guess is that if interest rates go up, then it would be a bad story for the Russell 2000. And certainly if we look at mega cap growth stocks, we have seen a fairly strong negative correlation between yield and the performance of those stocks. So I hope that made sense. Let me just check. Oh, we've got a member question from Gary Cunningham, who has supported us for a long time now. Thank you, Gary, for your support. And Gary says, during the 1956 Suez crisis, I read that the USA put pressure on the pound in the currency markets. What was this process? It's the first I've heard of that, actually. Now, clearly at that time, there was a kind of transition of power away from the UK to the United States. The UK was still a kind of colonial power at that point, and that was the final nail in the coffin of that worldview, that the UK was a kind of colonial power, I think. And so I think the US certainly wouldn't have been unhappy to see that the US was now becoming dominant in terms of being a world player. Although that was pretty much understood by that point as well, I think. But certainly that wasn't something I was aware of. That's really interesting, Gary. I'll have to read up on that. That is interesting. I wonder why they would have done that. Certainly the UK owed the US a lot of debt from the war. So if you think about it, if you're the US and you want the UK to repay its war loans, you probably don't want it to have a weaker currency, because then the dollar debt servicing cost would increase for the UK. So it wouldn't have been in the US's interest from that point of view, but maybe from a world power perspective, maybe that was the reason why they wanted to squeeze the UK. Interesting story, actually. It would be interesting to see what other people think is the reason for that. But it's not something I'm aware of. What an interesting question. Thank you, Gary. I'm always amazed by the quality of the questions on these Q&As. I just hope I do them justice. So the next question is from Kevin. What are your current views on having crypto as a 5 to 15% of our portfolio? Our portfolio. Thanks. Yeah, well, I mean, I have got, roughly probably about a 5% allocation to crypto, and it's fun. I think crypto is a great way to learn about investing, and things like where I recently did a Patreon members video, which is only available for our Patreon supporters, but it was about how to get started in crypto. And I think what was interesting there is that you can actually make it a lot cheaper to trade on a lot of these crypto platforms if you trade via their professional interface. So they have a kind of dumbed down interface, which is really easy. You just click on trade and you take whatever market price you get. But if you actually go for the next level up in complexity and go for their pro interface on Coinbase, for example, and on Kraken, then you actually see the market depth right in front of you in real time. And then you can put in a limit order, and you really get a feel for how markets work and how trading works for professional investors. And it's very easy to do. And the interfaces are just beautifully done. I think the kind of way a trade is executed suddenly becomes completely clear to you. And I think that gives you a really good understanding of markets. So to understand how markets work, I think crypto is great. Plus it's available 24 hours a day. The markets don't close. And generally the software behind it is just fantastic. So if I want to download crypto prices into R, there's a Crypto 2 library which gives me all of the historic data I'd ever want. It gives me market depth, daily market size. It's incredible. So I think in terms of the tech that's available and in terms of the training it gives you for understanding markets, it's great. And also for understanding risk and understanding that if markets go down, you don't sell. Stuff like that. It's very useful to pick up the intuition in crypto, but then apply it also to traditional markets. So I think a lot of the people who are entering markets for the first time, some of them will have entered it via crypto. And if that's the case, then, this is a great way to learn, I think. So, is it bad to have 5% of your portfolio in crypto? No. I just wish it was better regulated, because I think there are a lot of investment scams at the moment. So, for example, I had to fund my Kraken account 2 weeks ago, I think it was. I had to go through 3 separate warnings saying, this is a scam. This is a scam website. Don't do this. Are you sure you want to go ahead? So even I was scared, to go ahead with that. And if I hadn't been used to using that platform before, I would have been quite worried. And so I think it's difficult for some retail investors to actually differentiate between a scam and a genuine platform. And I think if it was a better regulated market, there'd be less risk to investors. So I think that would probably be a good thing. But it's just a matter of time until we have some crises and we get better regulation. I've got some grumbles here beneath me, so I think Ted is complaining because he normally gets a snack at this point, or to start. There we go. Good lad. That's very loud crunching, Ted. Okay, so next question. Let's see. There's an update from Gary who says the book is GCHQ by Richard Aldrich, and it's all about the Suez crisis. So I'll have to have a look at that. That sounds really interesting. Do you want one more, Ted? One more? Yeah, right. That's your lot. Okay, next question is from Rob, who says, hi Ramin, is a high point in VIX a good entry point to buy equity? Why or why not? Thank you. Well, generally what happens with VIX, if we have a look at VIX, let me just pull up VIX so you can see what I'm talking about. And I'll share my screen in just one moment. And if I add to that, share my screen. There we go. And I'm going to add to that S&P. Yeah, so let's add the S&P 500 to that, just so you can see what I'm talking about. So the blue line here is the S&P 500 index, and we'll go back further in time, and we'll look at a big crash. So let's look at what happened in 2008. So you can see what's happening with the equity index. So that's the blue line here. That's falling, and we had a very big fall in the S&P. It fell by over 50%, and at the same time VIX spiked. So generally when VIX goes above 50%, that usually means that we've had a fairly substantive market sell-off. And if we go back to 2020, to the pandemic sell-off, similarly, there was a 40% fall in the S&P, and we saw VIX spike to over 80%, much as it did in 2008. So is it a good time to buy equity when equity falls? Yeah. So VIX is one thing to look at. The other thing to look at would be valuation measures like the forward price to earnings ratio for the S&P 500. That'll tell you when markets are reasonably priced. Or look at CAPE, the CAPE measure. That's also another indicator you could use to look at whether markets are overpriced. And that'll tell you whether there are bargains to be had. But of course, if you go for particular sectors or stocks, there will be bargains which abound, right? So that's why I think it's useful to have this this idea of some kind of market crash portfolio, where you've got a kind of list of things which you'd like to buy, which are currently too expensive, but which you would buy if equity markets sold off. So if VIX does spike and valuations fall, I'm going to start buying the things on my market shopping list. And that also forces me to reframe a crash as a buying opportunity. So that's why I think the shopping basket idea is useful. And a couple of people have pointed out that you shouldn't keep money back from markets because you're worried about a crash, because any money that you hold back will underperform long term, which is true. But you could still move some of your core allocation from global equity, say, into these higher beta investments after a crash. It does mean moving some of your core investment into the satellite investments, but it would also benefit you because those high beta stocks and things which have taken a real beating will probably recover more than the broad market. So even if you don't have dry powder in the form of bonds or cash, you can still do this kind of market crash portfolio, market crash shopping list, as I called it. So there we, I think that's kind of useful mental tool in order not to sell when equity markets fall. At least I find it useful for myself. So a high point in VIX, is that a good entry point? Yes, it is. It is a good entry point. And the higher the better. Now, it could be that the markets go even lower, but if VIX is touching 80%, then usually that's a turning point. Not always, but it's usually a turning point. It doesn't usually go much lower after that point. At least it hasn't historically. Right. Next question is from Tim Maloney, who says, other than a black swan, what could potentially be the triggers or catalysts for the next market crash or bear market in the short or middle run, if any? Thank you very much. Yeah, I mean, the whole point of a black swan is that it's a low probability event. And, I've said several times that I think the biggest risk for equity markets at the moment is next year we're going to see the very strong earnings season that we've just had, which was an 80% year-on-year gain, fall to about 25% year-on-year earnings growth in the US for this quarter. Well, we get actually a report for the previous quarter, and then we'll get one more quarter of 20% plus earnings growth year-on-year. And then after those 2 quarters of strong growth, we'll go back to that awful growth that we had before the pandemic, which was 0 for 3-4 successive quarters. And I think after that point, when the Fed is also raising interest rates, people will have difficulty climbing that wall of worry, which is equity investment. At the moment, the Fed's still purchasing assets at a very high rate. It's slowing it down. The taper's started, but it's still at a high rate. Interest rates are still at their lower bound. And so risk appetite is still brisk, and we've just had some brilliant earnings seasons. But once those earnings start to tail off, we're seeing the raising of interest rates. There may be some residual high inflation, which would be scary as well. So that combination of raising interest rates, maybe residual inflation, weaker earnings, I think those are the biggest risks. But those are all kind of known unknowns, I guess. But the unknown unknowns, you can never forecast that. I think the problem, though, is you shouldn't hold back money from markets. And I have this conversation all the time during power hours. These are the one-to-one sessions I have, coaching sessions with clients, often high net worth clients, I should say. But I think those sessions, it's often a case of discussing ways in which to overcome your fear of buying into equity markets at a high valuation, because you don't know when equity markets are going to correct, and it could be another decade until they have a meaningful correction. And it's always good to remember those probabilities, 2, 6 and 16. So the probability of a 30% or more fall in the S&P over the following year is roughly 2%. The probability of a 20% or more fall is roughly 6%. And then the probability of a 10% or more fall over the next year for the S&P is 16%. So that 2, 6, 16 rule is useful, because if you live your whole life for that 2% probability of a 30% or more crash, then you just won't take enough risk in your portfolio and you'll underperform. So I think, having as much equity as you can stomach is good. Set aside some money for crises, and if you can scrape together more money if equity markets crash, then invest as much as you can during those crises, because as we started, that was the starting question. If you can possibly do that, it'll increase your long-term returns. Right, so the next question, let's just see if we have a members one. We do. So Stephen J says, thank you for supporting us, Stephen J. Stephen says, I heard you say negative bond yields have zero coupon payments, but doesn't the fund go down, the capital, in the short duration as if you had a negative coupon yield? So, yeah, so negative coupon yield bonds need not have zero coupon yields. So let's imagine that we had something like this, and I'm about to do some very bad drawing, so brace yourselves. So I'll share my screen and do my bad drawing, and yeah, here we go. So here's my bad drawing coming up. So let's say we're buying a bond, and we'll make it really simple. It's a zero coupon bond. So this is a bond where you buy it at a discount. So you buy it for maybe $99. You sell it hopefully at the par value, which is 100. So this is time along here. Now the idea is that you sell it for more than you bought it for and you lock in a gain. But you can have a situation where people are willing to buy this zero coupon bond for more than 100. So they might buy it for 101. So why would they ever do that? Why would you lock in a definite capital loss with a government bond? Well, the fact is that you don't know that yields won't go down even more and get more and more negative, because this is a negative yield of 1%. If this is a 1 year period, so if that's 1 year, then the yield on this bond would be minus 1%, because you're going to lose $1 in terms of capital loss. Why would you do that? Well, people do that when they're really scared. And I remember that there were Swiss government bonds that were selling at more than their face value. These were zero coupon bonds that were selling for more than their face value. And that's because people were so scared in 2008 that they were willing to make a loss on their Swiss government bonds. Plus there was the possibility that yields would go even lower. People would get even more scared and they could sell it for 102 before maturity, before the maturity of the bond. But what's never the case is that you end up paying the government a coupon. So it's always the case that for a government bond, so let's say you buy it for 100, it redeems at 100, and then you get some small coupon payments. Those coupon payments are built into the bond as it's issued, and they'll never be negative. It's never the case that these cash flows go negative. That never happens. They can be zero for a zero coupon bond, but they'll never be negative. So the coupon yield, never negative. But the yield on the bond altogether can be negative if you're paying a huge amount for the bond. So if instead of paying 100 here, if I paid, I don't know, 110, this would be a negative yielding bond. So it can happen, and it happens when people are very scared. That's the gist. So I hope that answered your question with my very bad drawing. Yeah. So will the coupon ever go negative? No, the coupon's frozen into the bonds when they're issued. It's always either zero or positive, and the yield can go negative. And there is no lower limit on how negative the yield can get. If people pay 200 for that bond, the yield will go even more negative. But it would take a new kind of crazy for that to happen. A kind of crazy which we haven't reached yet. At least not so far. Although I would never rule anything out, as we now know. Okay, next question is from Andrew Lester, who says, "Evening all, what are your views on the fees quoted? Often it's just OCF, which is the ongoing charges figure, but that is sometimes just a fraction of the total picture, I think." Yeah, interesting story there, because let me just pull up a story about Morningstar. Now, you're right, the ongoing charges figure is supposed to include almost everything, but there are a few things it doesn't include. And let me just get the downgrade of Downgrade of Scottish Mortgage. Now, if you're not aware, Scottish Mortgage is a UK ARC-K-like fund. So it's like Cathy Wood's ARC-K fund. It goes for funds which are disruptive. It goes for stocks which are disruptive, things like Tesla. In fact, it had many of the same stocks as Cathy Wood's ARC-K fund. Now, if you actually look at what happened, this was in 2020. Let me just share my screen again. So this is what happened in 2020. They downgraded Scottish Mortgage, despite the fact that it had phenomenal returns. It's got incredible, an incredible pedigree as an active fund. It's done very well. But what they said was that the ongoing charge, which is 0.36%, if you include the cost of borrowing, then that increased to 0.77%. So for investment trusts, which are closed capital funds, which can also borrow money, you also have to factor in, although it's not quoted, the cost of borrowing money. And when you do that, well, this is money you'd end up paying as a customer of Scottish Mortgage, as an investor. The overall fee would go up to 0.77%. And that would detract from the returns of the fund. So if you do have leveraged funds, what's the price of the leverage? That's one thing to consider. Now, most funds, if it's an ETF, it probably won't have leverage. In fact, it almost certainly won't have leverage built into it. But you will have things like trading costs, which also aren't usually mentioned. So for a fund which churns a lot, in other words, it's buying and selling all the time, then usually the trading costs can get quite big. Now, the difficulty for the fund manager's point of view is you don't know how much it's going to cost you to trade, because if markets become more volatile, you'll trade more, so the trading cost will go up. And because they're institutional investors, usually they just pay a few basis points, if that, on a typical equity market trade for a liquid stock. But they have to try and guess what the trading volume is going to be in the year ahead, and then from that work out what their trading cost will be. And under a new regulation called MiFID II, they do have to publish a fact sheet which says, for this fund, we think this will be the trading cost. And there's a certain methodology they have to follow to estimate it, and it is just a guess. But it's not included in the OCF figure, ongoing charges figure. But under MiFID II legislation, I believe they have to report that. So it really depends also on how much the fund trades. So a momentum fund, which has to trade a lot, will have a higher trading cost than, say, a volatility fund, where volatility tends to be fairly stable. So if it's based on the volatility of the stocks it buys and sells, the allocation, or a market cap weighting, then it'll trade a lot less than a momentum fund, say. So it really depends on the nature of the fund and how much the fund managers churn their contents. But I mean, the ongoing charges figure is pretty good. It does give you a good feel for the biggest costs. But the story about Scottish Mortgage I thought was interesting because it talked about leverage, which you don't usually think about, the cost of leverage. But it resulted in Morningstar downgrading Scottish Mortgage from a gold rated fund to a bronze, I believe. Was it gold? Was it gold to silver? I can't remember. But it's only got downgraded as a result. Right, another question. And don't forget to like our channel. It helps us a lot. And also subscribe to our channel, because then you won't miss stuff. Oh, we've got some more supporters questions. So these are people who've supported us on YouTube. You too can do that. Just go to the join button underneath this video window if you're watching it on your computer, and then you can join. And I think we tried to keep the cost of supporting us on YouTube very low. And then if you do that, which you can do right away now, then you'll get pushed to the front of the queue with your question. But Andrew's been a supporter for some time. I can tell by the colour of his crown. Andrew O'Connell says, looking at some REITs, those are real estate investment trusts. I like the look of Treg, which is sterling hedged and the fee is 0.25%, but Hargreaves Lansdown cannot offer this. The nearest match is HPRO, which is dollar denominated and the fee is 0.4%, or EPRA, which is denominated in euros and 0.24%. All three appear to track each other within 0.5%, but are in different base currencies. EPRA looks like a winner based on composition and total expense ratio fee. But in euros, is this a good, bad choice as it's a UK-based fund? Essentially, does base currency matter for REITs? It does matter to some extent, but remember that REITs are quite equity-like in the sense that they do tend to give you a high long-term return, which drifts upwards. And that's because their revenue also drifts upwards in time. And it's not capped in any way. So that will increase without limit. And it will be exponential. So that's why currency effects over a long period of time will matter very little for a REIT investment or for an equity investment. For a bond investment, currency matters more because there you don't get an upward drift, the capital gain is limited, you're primarily investing for capital preservation and maybe for a bit of income. So for bonds, I think it makes sense to equity hedge and to worry about equity, to currency hedge and to worry about currency. But for REITs, I don't think it matters as much. If you're holding it for the short term, it might matter. But it's a kind of very perverse thing to have to do, to have to buy a UK-based REIT in euros because that's the only one which is offered by your platform. It might be worth asking Hargreaves Lansdown if that's not a mistake. You know, sometimes they do make a mistake and mistakenly list the wrong share classes or the wrong currency. It does sound like a mistake. I mean, why would you not offer a domestic stock in domestic currency? That's very odd. Or maybe look at other exchanges, look at other platforms, see if they have the same thing. Yeah, that is quite odd. Not sure I understand why that would be the case. Right, next question is from Andrew Harrison, who says, hi, HMRC, which is the UK tax authority, that's like the IRS in the US, have invited me to pay in 15 years worth of NICs, and those are the national insurance contributions, at £800 a year. I'm 35 years from the retirement age and I have 2 years of NICs. I keep thinking this is a bad deal. Am I missing something? Well, worst case is that you wouldn't live to claim your NICs. So, you know, if you wouldn't live to claim your state pension. The idea is that you have to have a certain number of years of pension to get a full pension at retirement. So £12,000 is roughly what you'd get based on current estimates, which, you know, it's not a small amount and it's linked to inflation. So having a full NIC record is actually not a bad thing because you never know what's going to happen. You know, if you fell on hard times, you'd still have that state pension to draw on. So I think having a full record of a full set of NICs at retirement does make sense. And £800 a year isn't a lot if you consider what the state pension would be if you, say, increase it at 2% per year between now and the point of retirement, and then work out in a spreadsheet, if you live to 86, which is the average lifespan, how much is that worth today in today's money? And then you'll see whether it's worth the £800, and I think you'll see that it probably is. But, you know, the alternative is that you put more money into your pension and just see whether that's going to be better. But is it worth having that full NIC history, yeah, I think it probably is, because it will be inflation linked. And, 12,000 doesn't sound like much, but, when you're at retirement age, that could be quite helpful. Next question is from Andrew Lester, who actually answers Andrew's question. He says, what does he say? If you're going to amass about 35 years worth through working all your life, there's quite likely no point in paying. Judge it when you're 60, not 30. Been through the same hoops. There you go. So that's an alternative view. And Leonard von Nebelschutz, nice to see you, Leonard. One of our fans in the Netherlands. Nice to see you. I've had a couple of power hours with Leonard. Nice to speak with you. Antonio Peñado Leon says, hi Ramin, when you buy an ETF, are you buying it from another person selling it or the actual ETF provider? Well, it could be, the thing is the number of those units, the ETFs themselves, is always changing. There's a creation and redemption process, so if there's a lot of demand for the ETFs, then you'll get more created. If lots of people are selling the ETFs, then you could get less units in existence. So it's always changing. But from the point of view of the investor, you don't care. You don't care whether it's newly created or not, because its value, because of the creation redemption process, its value will always very closely track the value of the underlying investments. So if it's an S&P tracker, you'll notice that it's always very closely tracking the S&P. There won't be much of a difference between the two, because if there was, there's an arbitrage trade which the authorized participants, who are the people who can create and redeem these units for ETFs, they'll do the arbitrage trade and bring the prices back into line. And from their point of view, it's a very low risk trade with an almost certain profit. So that's why the tracking error is low on ETFs. So my answer is it doesn't matter, but most likely you're buying it from someone else. Okay. Not that it would make any difference. Okay, next question is, here we go. So a question from Andrew Lester, who says, Andrew Lester says, I've become increasingly interested in PE, that's private equity, I'm guessing, but is there anywhere I can find its correlation to more normal equities? So yeah, I mean, there is a way you can do that. So there are ETFs which wrap multiple private equity funds. So let's have a look at one of those right now. So IPRV, I think, is the one I usually look at. Yeah, here we go. So this is the iShares S&P listed private equity fund. And I'll share my screen again so you can see this. Now, this is the value of IPRV in black, and I've got the S&P 500 still in blue. And can you see that they're both very, very closely correlated? IPRV's increased in value more, but you can also see that if you look at the chart, you can see that it's highly correlated with equity. So when equity sells off, IPRV sells off, and when equity rallies, IPRV rallies. So the two are very closely related to each other, but it's like a high beta version. Private equity is like a high beta version of the S&P 500. High beta means that if the S&P 500 increases 1%, then IPRV will increase by 1% times some multiple, maybe 1.5. Just eyeballing this, I'm guessing it's about 1.2, something like that. But if equity markets fall, then this will fall by 1.2 times whatever the equity market fell by. So that's the drawback, which is that it also multiplies the downside if you invest in a high beta investment. So let's go back to me, back to the questions. So that's true. It's difficult to get the private equity numbers sometimes because they're less liquid and they're private, right? So public markets, the good thing is that they're quoted on a stock exchange. The only way to get these kind of aggregate numbers is to go for an ETF, which invests in multiple private equity companies. So that's an aggregate number that you're getting. But it gives you the feeling for how it reacts to markets, which I think is what you're after. Right. A couple of single stock questions, which I will not answer. Leonard says, good evening to Teddy. Ted, do you want another treat, mate? Come on. Treat. Oh, he's had enough. Doesn't want any treats. He's sleeping now. Yeah, please do like and share. It helps us a lot if you do that. And we have 15 minutes to go. And Chris 9K also says, don't forget to like the stream, y'all. I can't say y'all. The Big O says, in an equity crash, would you rebalance your equity bond portfolio on a monthly basis? You can do it that way, Big O, but if you are going to rebalance, I think it's probably best to have a set of weights in mind. So let's say you've just got two funds, a bond fund and an equity fund. And for the sake of argument, let's say 60% equity, 40% bonds. A better way to do it is only rebalance when they've fallen or moved away from those weights by a certain percentage. Because that way you just don't have to rebalance when you don't need to. I mean, you could just rebalance every month, even if it's only a little bit out of line, but that would be pointless. Whereas if you wait until it's about 5% or 10% out of line, then rebalance, it means you rebalance less. And you may go for long periods of time without rebalancing at all. But another alternative is just to never rebalance. You know, you don't have to rebalance. After a big equity market fall, then it does make sense to rebalance. Because what you'll be doing is you'll be selling some bonds, which have probably rallied, to buy equity which has fallen. So you'll be buying the equity at a discounted price, and then it does make sense to rebalance, almost certainly. And maybe when markets have rallied hugely, you're going to have a big equity allocation, bigger than you'd hoped. Well, maybe not bigger than you'd hoped, but bigger than you want to have in terms of risk. So then you can always sell some of the equity to buy more bonds and lock in some of the profit. But I actually did a video about portfolio rebalancing where I showed if you never rebalance, eventually after decades of investment, your portfolio becomes almost completely equity because the equity grows faster than the bonds. And that's actually a good thing because that way your portfolio compounds faster because equity on average gives you a higher return than bonds. So in fact, never rebalancing is also a good strategy, particularly when equity is doing well. Rebalancing when equity's fallen, I think does make sense though, because it forces you to buy equity when it's cheap and all the good things that flow from that. So would I do it on a monthly basis? Probably not. Would I do it on a percentage basis? Yeah, maybe. But I definitely do it on a valuation basis when equity is looking cheap. That's when I do sell some of my bonds to buy equity. Or you can use volatility, as we saw earlier. You know, if VIX is above 80%, that's probably a bargain. Rishab Jain says, how did you calculate 2616 probability? So this is a video I did, which was called Market Crash Probability. It was a cracker. So definitely go back and have a look at that one. But it was just counting. So I'd just go back in time. I'd look over 1 year periods historically, and I'd look to see how many times did the S&P fall by more than 10%, more than 20%, more than 30% over a 1 year period. And for the 30% falls, it only happened 2% of the time. So, you know, that's why the probability is low. So that's where it came from. I also looked at what happens when valuations are high, and that actually increases the probability of the falls slightly, or depending on the percentile of the expensiveness. So if it's very, very expensive, then there's a substantial increase in the crash probabilities. But, the base case, that's what I was trying to get to, which is the base case, which is the base probabilities, which is how you should allocate usually. The base probability of a crash is low. So don't live your life in fear of something which is unlikely to happen. I often see people make that mistake, and it's a mistake I make as well. What's your thought on Canada housing? Interesting. This is from Stalin Selvan. Now, it's interesting because I do have members of our Patreon community which are who are Canadian, and they complain endlessly about Canadian property prices being incredibly high. And the recent video I did on property prices, where I actually did a forecast of property prices based on income growth and the price to income multiple, you can actually have a fair crack at making forecasts based on those two numbers. But Canada certainly stood out as one of the most expensive markets. New Zealand, surprisingly, was another one. The US not so much in terms of price to income, despite the rapid increases we've had recently. After the 2008 sell-off, there wasn't a big pickup in US house prices after that. But yeah, Canada housing, very expensive. So as long as earnings growth keeps up pace with the housing market, you're okay. But in Canada, it's being really stretched. But again, just like the UK, it's a very regional market. So the popular cities on the east coast of Canada, they tend to have very high valuations. Or if you're looking on the west coast, if you look in, I think it was Vancouver. I can't remember the cities, but certainly there's a lot of variation, with the most popular cities, urban centres, having incredibly high valuations. And there was a nice example which I shared on social media of a shed which sold, I think it was in Montreal, and it was like 700,000 Canadian dollars for this shed, which is kind of crazy. Right, so let's move on. Have another look at the members' questions. Oh, we've got some member questions. And yeah, so we've got a question from Ola Yurokan, who is a new member. Thank you, Ola, for supporting us. Remember, if you do want to have your question pushed to the front of the queue, you can always support us on YouTube. It's very cheap to do, and you get pushed to the front of the queue during these sessions, and you're supporting us, which I appreciate. Ola says, can I just open an ISA and transfer it to her at a point I feel she's able to manage it? Okay, so I'm intending to open a junior ISA for my daughter. So this is a tax sheltered account in the UK called an individual savings account, and a junior ISA is for your kids, and you can put in about, I think it's there's a limit that you can put in every year. It doesn't have to be you that puts the money in. It can be any relative or friend of the family even. So it's a nice way to give a gift to a child in a tax-sheltered investment. But of course, your daughter will be able to control the fund when she's 16 in terms of its investments. And then at 18, she can do whatever she wants with it. So if you're confident that your daughter won't just splash the cash, and you're not happy for her to do that, then an ISA might not be a suitable investment for her. So you can buy SIPs in a pension effectively for your children, and I did a video about that. I think it was called How to Make Your Children a Millionaire. But if you put money into a SIP, they can only touch it when they retire. So you don't actually have to put that much in because of the compounding effects to make them very comfortably off in retirement. But again, they will be able to control the investments in it once they reach 18. So you've just got to make sure that you've trained them to invest wisely. And what better way could there be than to watch our channel? Right. So Yes, but you can open an ISA, but I don't believe you can transfer your ISA to her account. I don't think that's possible. So no. And you have to use the annual limit, just like your ISA. So she'll have her limit. So the UK ISA limit for junior ISA. Junior ISA limit 2021. So that's currently £9,000 a year in 2020. So that's how much you can put in per child every year. So if you don't use that in a given tax year, you won't be able to use it. You won't be able to backdate it. So I think you just got to learn to trust your kids, right? or just teach them to invest it wisely. Right, back to the questions. Oh, there's a super chat. Oh no, we've got one. Stephen J is asking another question. He's one of our supporters. Well, actually, I'll answer James Hendry first because he hasn't had a question answered. And James has kindly done a super chat. Thank you, James, for £5. Thank you. He says he's new to investing. Thoughts on LifeStrategy 60/40 versus building a 5 or 6 fund portfolio around the US weighted VUSA ETF. Any help appreciated. Well, I actually did a video where I showed how to recreate Vanguard funds, Vanguard LifeStrategy funds, using I think it was about 4 or 5 of the Vanguard funds, or about 6 iShares funds. And what's odd is that it's actually cheaper to build your own LifeStrategy, and you can almost perfectly match the returns of LifeStrategy with just 4 or 5 funds. And the other funny thing was that iShares was actually cheaper. So to replicate Vanguard LifeStrategy funds using iShares funds was actually cheaper than using Vanguard funds. And again, you can match the asset, you can match the fund returns very closely. So have a look at that video and you'll see exactly how to do the recreation. The other good thing about doing that is that you can dial down the UK overweight and substitute it with global equity. Because one of the things I don't like about the Vanguard LifeStrategy funds is their huge UK overweight, which is, many times the market cap weighting for the UK. And the whole point of LifeStrategy is that it's supposed to make investing, it's supposed to reduce the cognitive biases of investing, because you trade less and it's kind of, you're always encouraged to save and it's simple. But the domestic overweight bias, which is a very strong one, I often see UK investors put too much into too much UK weighting onto their portfolios relative to market cap. It's strange that Vanguard doesn't try and overcome that. But apparently it's because they can market their funds more easily, because it's more familiar to have more UK equity in it. But anyway, if you roll your own LifeStrategy, you can dial down the UK and dial up global equity, which I think makes sense. And it gives you that flexibility. But the rebalancing is more difficult, although the overall fee is lower. So have a look at that video. I think it was called, it had the word LifeStrategy in it anyway. Recreate LifeStrategy, something like that, or roll your own LifeStrategy. Next question, last question I think, or close to, because it's 5 minutes to go, is from Stephen J, who's one of our supporters. Thank you, Stephen. Is it when the break-even inflation rates, BIRs, are higher than CPI, is it worth to buy inflation-linked bonds? Also, would it be worth it to buy UK inflation-linked bond gilts if I'm outside the UK? Thanks. Now, if you buy foreign, i.e. non-domestic inflation-linked bonds, what you're doing is just speculating on investment elsewhere. If you buy it in your own currency, like, my living expenses are based on UK inflation. So if I buy UK inflation-linked bonds, then, for me, that's hedging my life expenses. But if I were to buy US tips, that would just be speculating on US inflation, because I don't feel US inflation. I feel UK inflation. So is it worth buying index-linked bonds outside your country? Yeah, but only if you understand that you're speculating on inflation in that country or in that region, if it's a Eurozone. But break-even inflation, the idea behind break-even inflation is when, let's say we've got two bonds which are issued. One is inflation-linked. Both are issued by the UK government. One is inflation-linked, the other one isn't. The one which is inflation-linked will have a lower coupon than the one which is not inflation-linked. And in order to catch up with the coupons of the nominal bond, the normal bond, inflation has to exceed the break-even rate of inflation over the life of the bonds. So they have the same maturity. The coupon will be lower on the inflation-linked one, and to catch up, inflation has to average the break-even rate. If that isn't true in the future, then you'd have been better off with a nominal bond because the coupon started off higher. And I think that a lot of people don't understand that about inflation-linked. So if the break-even rates are high, as they are in the US at the moment, then inflation has to be pretty punchy over the lifetime of the bond, and it has to exceed the central bank's remit, which is to keep it at 2% for a long period of time. So effectively what you're betting on is that the bank has failed to do its job consistently for the next, say, 7 years, depending on the maturity of the fund. So that's a pretty strong belief if that's what you're betting on. So that's why I think for many people, inflation-linked bonds don't make sense. Also in the UK, if you look at inflation-linked funds, they tend to have very, very long duration. And that means they're very sensitive to interest rates. So if real yields increase, if the yield curve moves up, effectively, then they'll lose a lot of money. So they're very volatile for starters, and you could still lose money if yields move up, which is probably going to happen over the next year or so, next year, 2 years. So you will lose money due to the duration effect if yields increase. But if inflation increases a lot, by more than the break-even rate, then you'd have been better off with the inflation-linked bonds. So it's not based upon break-even inflation today. It's based on the average over the next, roughly the duration of the fund, that number of years. So, I think for a lot of people, it's not a clear-cut decision as to whether you should, inflation's gone up, I'm going to buy inflation-linked bonds. No, because it has to stay high for a long period of time, potentially, in order to be worthwhile. Okay, so how are we doing for time? I think we're out of time. We've only got 1 minute to go, so I'll just end it there. Thank you all for joining us. I hope that's been useful for you. I think markets at the moment do look overpriced. But as I say, I don't think that's a reason to hold back from equity. That's usually a bad idea. But remember, if you do want to support us, you can always join us on Patreon, or you can support us here on YouTube. But our preferred choice would be Patreon, because there you can join us on Slack, and you also get a huge library of members-only videos which cover a very wide range of topics. Lots on inflation, for example, lots on bonds, lots on alternative investments, for example. So yeah, do consider joining us on Patreon. We'd love to see you as a member of the community. And you can also have a one-to-one with me during a power hour. And so this would be the conversation we'd have, but it would just be you and I. So a lot of people like those coaching sessions because they can ask very specific questions about their own investment views and use me as a sounding board to see whether their portfolio kind of makes sense or whether there are other things which they should consider. So have a great 2 weeks. We'll see you again in 2 weeks' time. Getting pretty close to Christmas. But have a great 2 weeks, everyone, and see you then.